The signs are everywhere, but no one's connecting them. Inflation cooling, but prices still rising. Yield curve inversion deeper than ever before. Debt at record levels and growing faster than ever. Everyone's waiting for the next 2008. But what's coming in 2026 might be far worse. Not just a market crash, but a collapse in the very system that keeps it all running. The last time the world looked this fragile was 1929. But unlike then, this time there's nowhere to hide, because the problem isn't one market, one country, or one policy. It's the entire foundation of modern finance. And when that foundation cracks, everything built on top of it will shake. Welcome to the Crisis Banker, where finance, economics, investing, and history meet. Here, we break down what's happening in the markets, why it's happening, and what it could mean for you. From warning signs of economic collapse to hidden opportunities, we explore the patterns history repeats, so you can understand today and prepare for tomorrow. So, like, subscribe, and share to stay one step ahead of the next crisis. Chapter 1. The Signals We Ignored. Every economic collapse begins with warning signs, and 2026 has more of them flashing at once than at any point in modern history. The first, and perhaps most important, is the yield curve inversion. It's simple. Short-term interest rates are now higher than long-term ones. That means investors are demanding more return to lend money for just a few months than for 10 years. A clear signal that the near future looks riskier than the distant one. This isn't a theory, and it's one of the most consistent and reliable indicators ever discovered. The yield curve inverted before every single U.S. recession since the 1950s, without exception. And today's inversion isn't just deep, it's historic. The last time it stayed inverted for this long was right before the 1929 crash. History doesn't repeat exactly, but it does rhyme. The second major signal is even bigger: government debt addiction. In 2020, the world printed more money in 1 year than in the previous century combined. Central banks and governments unleashed over $20 trillion to keep the system alive. But when the emergency ended, the printing didn't stop. It became the new normal. Now debt is rising faster than GDP in nearly every major economy. The United States is adding over $1 trillion in new debt every 100 days. Japan and Europe are trapped in negative real yields. Emerging markets are drowning in dollar-denominated loans. This isn't stimulus anymore, it's survival. And survival spending has a cost: inflation, that never truly goes away. The third signal? The AI bubble. Just like the dot-com mania of 1999, investors are throwing record amounts of money into anything labeled artificial intelligence. Semiconductor stocks, automation startups, and data companies are trading at valuations disconnected from real earnings or adoption. Every generation has its miracle technology: railroads, radios, the internet, crypto. The innovation is real, but the valuations are fantasy. When liquidity tightens and profits can't match the hype, these stocks will be among the first to deflate. The fourth signal? Consumer exhaustion. Credit card debt has passed $1 trillion for the first time in history. Savings rates have fallen to levels not seen since 2005. Wage growth is slowing, while inflation continues to quietly erode purchasing power. People aren't just running out of money, they're running out of confidence. And when consumers lose confidence, economies stall, because the modern system runs not on productivity, but on spending. The final signal, and perhaps the most deceptive, is the illusion of recovery. The stock market is near record highs, yet small businesses are failing at increasing rates. Home prices are inflated, but affordability is at a 40-year low. The unemployment rate looks strong on paper, but more than half of new jobs are part-time, gig, or government-supported. It's the same disconnect that defined 1928, the final calm before the storm. Back then, people believed the party would never end. Today, we believe technology will save us, central banks will protect us, and markets will always bounce back. But history tells a different story. When optimism and leverage rise together, collapse isn't a question of if, It's a question of when. Chapter 2. How to prepare. Every collapse looks sudden, but in truth, it begins slowly, then all at once. So how could the next one start? The answer lies in pressure. Pressure on currencies, pressure on debt, pressure on trust. Because what we call a crisis is often just the market forcing reality back into balance. Inflation has been hidden by financial engineering, debt has been masked by new accounting tricks, but eventually, gravity wins. The question isn't if a correction comes, it's what kind of correction it will be. And when it happens, what can you do? You can't control the collapse, but you can control your exposure to it. Preparation isn't about fear, it's about positioning. Every investor in history who survived a crisis shared one principle: diversification across realities, not across funds or tickers, across types of value. Let's break that down. Before we go further, let's be clear about something. Nothing here is financial advice, this is opinion. If you choose to invest, always speak with a qualified professional first. Every investment carries risk. Prices can fall. Markets can move against you. You can lose some or all of your money. So how do you survive the storm and position yourself for the calm that follows? The answer isn't prediction, it's preparation and psychology. Because markets don't just move on data, they move on emotion, on fear and greed. The investor who panics at the bottom locks in their loss. The one who buys recklessly at the top sets up their fall. The difference between those two is not intelligence, it's temperament. In every crisis, the hardest skill isn't choosing the right asset, it's mastering your own mind, because when everyone else is losing theirs, calm becomes an advantage. So what practical steps can you take when uncertainty grows? 1. Cash and liquidity, the oxygen of opportunity. In every crash, liquidity is what separates patience from panic. When markets tumble, those holding cash aren't spectators. They're the only ones with options. Liquidity lets you wait instead of react. It gives you the freedom to buy when prices fall below fair value and everyone else is too scared to act. Historically, portfolios with 10-20% in stable, liquid reserves recover faster after downturns. That buffer acts like oxygen when everyone else is gasping for air, not forever, but long enough to seize opportunity while others are still frozen by fear. 2. Real assets, the anchors of reality. When trust in paper money erodes, tangible value becomes the lifeboat. Gold, commodities, farmland, energy, and productive real estate don't depend on quarterly earnings or political promises. They simply exist, real, useful, scarce. In the 1970s, when inflation exploded, gold outperformed stocks by over 1,300%. During the 1940s, while economies fought wars and currencies devalued, farmland quietly built generational wealth. Real assets remind you that value is not a number on a screen. It's something that feeds, powers, or shelters people. Therefore, 15% to 25% allocated to these type of investments make sure you stay standing when paper wealth melts away. 3. Equities, but only the anti-fragile kind. Crashes don't destroy every company. They reveal which ones were fragile all along. The firms that survive are those with strong balance sheets, real products, loyal customers, and low debt. In 2008, Apple, Microsoft, and McDonald's all had massive cash reserves. And while others collapsed, they captured market share and grew stronger. Owning equities isn't about chasing hype. It's about owning resilience. Businesses that make essential goods, pay dividends, and adapt fast tend to outperform speculation in the long run. Therefore, an allocation of 35% to 45% can help when markets turn. Because after every bear market in history came a bull market that rewarded those who stayed in the game. 4. Innovation and optionality. Small bets on the next world. Every crisis plants the seeds for the next boom. The dot-com collapse gave birth to Amazon and Google. The 2008 crash gave rise to Bitcoin and decentralized finance. The 2026 correction might do the same for AI, clean energy, or decentralized systems that replace outdated institutions. A small slice of your portfolio, even 5–10%, in future-oriented innovation is like buying a ticket to tomorrow's recovery. Most of those bets won't skyrocket, but one might define the next decade. 5. Skills and knowledge. The invisible asset class. The most powerful investment doesn't trade on any exchange. It's you. In uncertain times, knowledge compounds faster than capital. Learning new skills, mastering technology, or building something useful can't be inflated away. When the system resets, it's the builders, thinkers, and creators who rebuild it, and they're paid accordingly. No market crash can erase skill. It's the one investment that always pays dividends. Now let's address the truth most investors avoid. The greatest risk isn't your portfolio, it's your psychology. In markets, fear and greed are the twin engines of destruction. Fear makes you sell at the bottom, greed makes you chase the top. The disciplined investor learns to do the opposite. They buy slowly when fear dominates through dollar-cost averaging, investing a steady amount over time, regardless of market noise. That simple habit, backed by decades of data, has beaten emotional timing again and again. Because the truth is, wealth is built not by perfect timing, but by staying invested long enough to let compounding do its work. Markets recover. They always have. The only investors who lose everything are those who panic and never return. History shows that after every major crisis, long-term investors who kept their discipline were rewarded with decades of growth. Even when everything looks broken, the next boom is already quietly forming. Stay patient, stay focused, stay human, and when the world forgets how to believe, that's your cue to start building again.